Hello and welcome back to the Express Notes for ACCA paper F7. Remember to download the Express Notes from our website www.theexpgroup.com. Okay? We'll cover chapter 5, which basically deals with predictive value. We have said from the beginning of these Express videos that we basically produce financial statements to provide information to the users with respect to financial position and performance of the company. And we have discussed certain characteristics that the information presented in the financial statement should have in order to be relevant and reliable also to the users. So we have discussed the potential conflict between what is reliable and what is relevant for the users. So if you are an investor in a company, basically what you'll be most interested in is to be able to kind of predict, okay, based on the historic past data that you receive, what is the profitability of the company, especially what will be the future profitability of the company, how will this actually vary from the previous years, so forth and so on. So in order for you to kind of decide whether or not you'll keep the shares in the company. The problem appears due to the fact that I have to take this decision based on past historic data, which is basically at least 4 to 5 months old when I'm actually receive and read it. In order to kind of solve this problem of the need for reliable and relevant data for decision making, there are a number of standards which have or try to enhance the predictive value in financial statements. One of these standards is IAS 8. IAS 8 is mainly dealing with how shall we present the information in the financial statements when we actually have a change in either an accounting policy, so something has changed, either an accounting policy, either an accounting estimate, or we find an error, and we are talking here about material errors in the financial statements that were previously released for publication. So, with respect to accounting policy, it's the company's job or management job to decide which those accounting policies should be. Look at whatever is the main of activities that you're basically doing, and look at the relevant IFRS standard and pick an accounting policy which is more suitable to your company in order to present information relevant to your users. Now, this accounting policy should be applied consistently from one year to another if we want the information presented in financial statements to actually be relevant to our users. There may be reasons where we are basically forced during an existence of a company to change the accounting policy. And IAS 8 recognizes two such instances. One, when a new IFRS is actually released or an old IFRS is reviewed. So for instance, when IAS 10 with events after the reporting date was reviewed, it actually classified as a non-adjusting event the dividends which are declared after the year end but before the financial statements are authorized for issue. Or IAS 23 borrowing cost was reviewed and actually requires the capitalization of the borrowing cost into the value of the asset which is either bought or constructed over the period of construction. So if this is the case, there is no choice for the company but to actually apply the new accounting policy. The problem appears that this application cannot be, from this moment, the moment of change onwards, because in this way I will actually lose the comparability in the financial statements. So the common sense will basically tell us in the exam to actually go back and restate the prior year figures to the earliest possible periods in order to actually restate the data as if the new accounting policy was in place, even in the prior periods. The same accounting treatment I will use whenever we discover an accounting error. So that is called, if you want, retrospective application. Retrospective application. And we will do this every time there is a change in an accounting policy or we find an error. When we actually change an accounting estimate, like let's say we decide this year to increase the provision for bad debt from 2% of the year-end balance to 5% of the year-end balance. That is not a change in an accounting policy. That is actually a change in an accounting estimate. And with an accounting estimate, there is no need to go back and restate prior year, because the estimate in the prior year periods was correct. So at the end of the previous year, the 2% that I booked as a provision for bad debts at the year end was reflecting the conditions at the prior year period end. And therefore, with a change in estimate is prospective application, which we will apply, meaning from the moment of change this year onwards, as long as the conditions that actually lead to the change will still apply. So with an accounting estimate, as the name says, it's our best estimate each time at year end. So this is not a correction of error, it's just a new information that it's applicable, 5% in our example, at this year end. The problem is that with an error, it's just an omission or a misuse of the information which was available at the previous year end, or we could have been reasonably be expected to obtain it. So, in short, a change in an accounting estimate, it's normal. It will probably be the case each and every year. With an error, this is abnormal. Okay, it should not appear, or it should not have gone through to the financial statements. That is just a plain mistake which I want to correct. How will I correct it? Obviously, I will have to describe it in the notes. What actually led to the change of in accounting policy, what led to the error actually to be reflected in the prior year financial statements, what is the effect of any restatement or corrections now. So for a retrospective application, all I want to make sure is that the users of the financial statements, which have seen the previous year financial statements, okay, will understand that a change has occurred either in the accounting policy or we are just correcting an error. Like for instance, I don't know, I included in year-end inventory something which was already sold, for instance. And therefore, all I have to do is to go back, affect the lines of assets and liabilities as if the new accounting policy or the error did not exist in the prior year, and adjust the opening balance of the retained earnings. This is basically how we retrospectively correct an error or apply a new accounting policy. With IFRS 5, which is a non-current asset held for sale and a discontinued operation, and the way we have to reflect this into the financial statements, we have to keep in mind that the non-current assets and part of our business is no longer going to be available in the next 12 months. We will sell it. So the value of a non-current asset will not be recovered by constant use within my business, but via a sale transaction. And I want to hint actually towards my users the fact that a non-current asset will be sold, and therefore the accounting treatment which we normally apply for a non-current asset, I don't know, depreciation over the useful life, is no longer available in order to present relevant and reliable information. We have to actually disclose the fact that the non-current assets, or the group of non-current assets, which is actually called a disposal group, will actually be recovered via a sale transaction. In order to reflect this into the accounts, the sale should be highly probable, and the asset or the group of assets should be available for sale in their current condition. So I don't have to do any repairs to the asset before I actually sell it. A plan should actually be approved by the board of directors, and management should actively seek a buyer, meaning they should not ask a price, for instance, that is way above the market price of similar assets that were recently sold in the current market conditions. Because if this is the case, it means that you actually do not intend to just sell the asset. When we are actually classifying a non-current asset as being held for sale, all we have to do by the year end is make sure that we measure the asset at the lower of the carrying value and the fair value less cost to sell. Carrying value of a non-current asset is actually cost or revalued amount, depending on which accounting treatment we are using under IAS 16, less accumulated depreciation and less accumulated impairment losses. This carrying value should actually be compared with fair value less cost to sell, meaning what's the selling price less any selling cost. And what IFRS 5 says, if we are actually planning to sell the disposal group of the non-current assets in question in more than 12 months, we should actually reflect this at the present value. Remember, we talk about taking into consideration time value of money, meaning I have to discount back usually my weighted average cost of capital and show this at present value, and then increase the value with the change in the year by booking a finance cost in the income statement. Once I classify a non-current asset as held for sale, I shall not be depreciating or amortize it if it's an intangible asset from the moment when it's classified as held for sale or until the moment of the actual sale. In terms of presentation in the statement of financial position, we will not show the disposal group within non-current asset, but as a distinct category within the current asset called assets held for sale. Standard actually deals with also discontinued activities, okay? And a discontinued activities should be a major line of business, okay? In other words, it should be a reporting segment under IFRS 8, something that your chief operating officer will actually look at, and it would be either a geographical area of operation or a major line of business. So I'm operating a hotel industry and I'm also producing airplanes. Therefore, if I decide to sell my hotel business, that's a discontinued operation. Or I can be operating in the same industry. Let's keep the example with the hotel industry, but I want to sell or my Asian hotel chains or my Asian operations. Okay, so it should be a separate line of business. Okay, it should form part of a single coordinated plan to dispose of it. Okay, or it may be a subsidiary which is held exclusively with a view to resale. Basically, I bought it without my intention. Disclosure requirement for discontinued operation. Those are basically two. You have to show a single amount on the face of the income statement, which comprises the total post-tax effect of profit or loss from the discontinued operation, meaning how much was the profit or the loss that was incurred by that operation this year, and the post-tax gains or loss recognized from the measurement to fair value less cost to sell, or on the disposal of the assets of the disposal group, which actually form part of the discontinued operation. So if you remember, or if you go back and look at our video where we basically talk about IAS1 and how financial statements are actually looking like, we see one line in the statement of financial position which actually takes the net effect of how much was the profits along with the gains derived in the accounting period from the operation that is going to be discontinued within the next accounting period. And if you take this approach, we have to disclose in the notes a summarized statement of comprehensive income, if you want, for the discontinued operation. We will have to show all the revenues and related expenses generated by the discontinued operation, the pre-tax profit, the income tax split between current and deferred tax, any gains and losses that occur due to the measurement to the fair value less cost to sell, and the net cash flows that the discontinued operation actually generated during the accounting period, which is going to be split between operating, investing, and financing activities as in accordance with IAS7, which deals with statement of cash flows. Comparatives shall be presented for the discontinued operation by the year end, again in the notes. This disclosure can be taken on the face of the income statement or in the notes. So basically part B, okay, can be reflected directly in the statement of comprehensive income by, for instance, splitting the income statement into a column which is called continuing operations and the column which is called, obviously, discontinued operations. So basically on a line by line, I will present revenue, cost of sales, gross profit, all expenses, so forth and so on a line by line basis for both continuing and discontinuing operation, and thus increasing the predictive value of the financial statements. Another standard which actually has a predictive value for our users is IAS 33, earnings per share. Only quoted companies are required to follow basically the requirements under IAS 33, but this IAS can be applied also by not quoted companies, but if they choose to do so, they should fully follow the requirements of IAS 33. So many investors, many financial institutions or financial advisors will actually choose to value a company by, a price earning ratio, meaning divide the share price over the earnings per share. Okay, and you evaluate the company by reference to a multiple of its current year earnings. Since they are doing this, at least for the quoted companies, we should have the same methodology which will be applied by all quoted companies, for instance, irrespective where or of their activity, where they operate or what their activity is. Okay? So basic calculation for earnings per share will actually divide the earnings before the ordinary dividend over the ordinary shares in issue. In other words, to remember this easily in the exam, you will actually take the profit from the current year earnings, which can actually be attributable to ordinary shareholders. And by this, I mean I take the profit after tax, I take out any non-controlling interest if we are in a group scenario, I take out any preferred or preferred dividend, which I'm actually paying out. And I divide this by the ordinary shares, which are in issue at the year end. Now, for the exam, in order to properly calculate basic EPS, we have to remember two things. Now, the number of shares in issue in your real life exam scenario will change from what it was at the beginning until what it is at the end of the year end. So a key concept for you to basically remember is the fact that there is a link between the number of shares in issue and the net assets that the management has at their disposal to generate profits during the accounting period. So in other words, if I'm issuing, I don't know, 1 million shares at the beginning of the period, I cash it. I use that cash to generate future profit into this accounting period. Now, this will not be exactly the same figure if I'm actually issuing shares somewhere partway into the year, let's say halfway into the year, or if I'm issuing shares just 1 month before the year end. I'm still getting the cash, but the asset which I'm actually getting, they don't have enough time to generate future profit in the year, as it was in my previous example, where I have the full 12 months in order to put the cash at work to generate future profit. That's the main idea. So every time there is, this link is broken. So I'm issuing shares for which I'm receiving some cash, which actually will generate profit. Every time there is a missing link somewhere into this chain, okay, you will have to adjust or restate the earnings per share. So in order to calculate this, basically the ordinary shares in issue will actually be replaced by weighted average number of shares, which we'll have to calculate for the full period. In order to easily remember this in the exam, maybe a tabular form, it will be of help, meaning put down the date at which number of shares or something happens within the number of shares, the number of ordinary shares which are in issue until the next change, the period of time, 3 months, 6 months, 12 months, okay, and inflate it if you're having some bonus issue or some rights issue. And by just multiplying the number of shares with the period and the inflation, you will get what I call the weighted average number of shares. And we will be actually using this weighted average number of shares when we calculate the basic EPS. Now, why do I say this element of inflation? So think, for instance, if you are issuing some bonus issue, meaning to the current existing shareholders, you are giving them some shares for free. So coming back to what I just explained a little bit before, every time there is a missing link between issuing shares, getting cash, and generating profit, we will have to pay attention to the way we actually calculate the earnings per share or the weighted average number of shares. And in a case of a bonus issue, I don't cash anything, as the name says. I give them some shares, meaning I'm just increasing the ordinary number of shares in issue by the bonus issue. There is no direct relationship with the earnings or with the profit. So, for instance, if my profit was 10,000 and I used to have 1 million shares in issue, basically the earnings per share were 10,000 over a million, and you express this in cents, that is 1 cent per share. Now, if nothing else happened, nothing else, but in the next accounting period, which is year 2, I generate the same profit, 10,000, but all of a sudden I make a bonus issue of 1 share for every 2 held, meaning I issue 500,000 shares. It actually means, if you are just calculating basic earnings per share, now I have to divide the 10,000 over 15 or 1.5 million number of shares, which multiplied with 100 will actually drop us to 0.66 cents per share. If I leave it like this, okay, the shareholder will basically see that in the prior year they actually earned 1 cent per share, but now they actually earn 0.66 cents per share, which is not giving a true and fair view of whatever happened during the accounting period. The same thing is when we talk about rights issue. Rights issue is basically an issue below the market price, meaning to the same existing shareholders, basically, I give them the right to buy a share, but they buy a share below the share price, which is quoted on the stock exchange. So, hence, again, this link between shares, cash, and profit, it's a little bit broken. Okay, I receive some cash this time, but the cash which I'm actually receiving is less than the market value that will actually help me to generate future profit. And that's why, to work out this, what I call inflation effect, okay, we will work out based on, let's say, the number of shares that I can actually issue at the full price using the before and after rights issue. So what I mean is basically, if you issue 1 for every 2 shares held, and the share price that you're asking is $1, but the share price on a stock exchange is actually $2, basically you are given half of the share for free, or you are giving half of the potential money that you can generate. Okay, so the idea is that with $1, basically I can buy only half of share on a stock exchange, and basically what you need to work in the exam is theoretical X rise price. Okay, in order to calculate this, in order to adjust the number of shares in issue, how I calculate this, we have to look at the net assets for each share before and after the rights issue, and therefore will reflect the potential earnings of each share at the year end. So if you want, it's a combination basically of shares given for free and shares bought at full price. Now, IAS 33 is requiring quoted companies basically not to state only the basic EPS, but also to state on the face of the income statement the diluted earnings per share. So meaning I want to signal to the current shareholders that there are some instruments in issue now that will actually potentially dilute their ordinary shares. So for instance, directors may have share warrants or share options, okay? So as long as they work, let's say 3 years for the company, they have a right to buy either cheaper shares or to receive shares for free. There are convertible bonds in issue, meaning this debt instrument, okay, at the end of its life will give the right to the holder to actually ask for the money back or be issued some shares. Or there may be some preferred shares that the holder also can convert into ordinary shares. But the option does not lie with the company, but with the holder. So, as long as we have this such type of instrument in issue, basically the company will be forced to issue new shares, and the current shareholders don't have access to actually buy it. So they will basically be diluting their interest in the company. And we have to give them a warning of this effect. How we should, or basically we should cover this in the exam is the following. We do calculate first the basic EPS as normal, okay? Remember weighted average number of shares, be aware of bonus or rights issue. Then identify all the obligations at year end that could give potentially ordinary shares, okay? And in the exam it will be given to you, okay? You will be told about three types: warrants, convertible bonds, or convertible preference shares, okay? And we have to calculate the effect on earnings and also the effect on the number of shares of the potential ordinary shares that is actually issued. So if you think, the formula for the basic EPS, okay, is the profit available to ordinary shareholders divided by the weighted average number of shares, okay? So whenever I have a convertible instrument, okay, or warrants, okay, I have to take into account the effect on the profit, so the effect on the profit and the effect on the number of shares, or both. And we will calculate the diluted EPS for the worst case scenario, meaning the most dilutive effect. So if you're talking about warrants, meaning the management, the top management of the company is entitled to receive some shares. Either they will receive it free of charge, or they will be receiving at the price which is below the market price. And therefore what I'm left to actually calculate is the effect on the profit and the effect on the ordinary number of shares I know. So with the money which I'm actually cashing from the management who is actually buying the new shares, okay, I divide this by the full market price, and that will actually give me the number of shares that does not have any dilutive effect on our results. And the rest will be treated as free shares, and therefore will have a dilutive effect, which is indefinitely, as the standard says. Then we might have convertible bonds, which is an examiner preference, if you want, prefers this. I don't know why, and I will cover it in full when I will talk also of financial instruments. But it may be tested in calculated, basically diluting earnings per share in the exam. So convertible bonds will actually lead to an increase of profit. Why? Because I no longer pay interest. But make sure when you calculate the effect on profit, you take this net of tax, because interest is a fully deductible tax expense, and therefore you will no longer have the interest expense, but you will have increased profits, and therefore you will be paying higher taxes. And take into consideration the impact on the increase of the number of shares based on the conversion ratio, which will be given to you in the exam. And in terms of convertible preference shares, okay, that actually they pay a preferred dividend. So this dividend will no longer be paid, but we will not be, this is not a tax deductible expense. And also we will have an increase in the number of shares based on a conversion ratio. And we'll have to basically take this into consideration when we actually calculate the diluted earnings per share.